What's red ocean?
Red ocean, highly competitive market, lots of competition.
And it's red because there's blood in the water.
Exactly.
Yeah.
Chum is just getting devoured by the sharks.
It's a noble mission. It's a noble mission.
Blame value creation. Don't blame, don't blame the operating partner.
It's not venture capital. It's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat.
Welcome to the Funcast. We've got a good one for you today. We're going to talk about private equity lingo because earlier in your career, when you first get going in the industry, people are talking about stuff and using acronyms and words you've never heard of that are barely even English. And for most management teams, they come out of their first few meetings with private equity, scratching their head, wondering what they're even talking about. So as we're here to be useful and helpful at the Funcast, I've got two of my favorite people on the planet and two great associates at ParkerGale, Niko and Liz. Welcome to the pod.
Yeah, excited to be here. It's going to be interesting.
And this is your first podcast, so I'm gonna help you through it. We'll get there, and this is a fun one to start with. So we'll just get the podcast juices flowing. So let's start with private equity terms. Where do you want to start?
Yeah, I think let's just even level set like what private equity is. There's private equity and there's private credit. So like I know 5 years ago, I didn't understand the difference really between the two. And obviously they're very different. So
all right, I'll do my best.
Yeah.
So here we are. So private credit, which is super hot right now and in the news.
Yeah.
It's grown massively and may or may not be a cockroach, according to Jamie Dimon. We will say private credit is just the debt side of private equity. So private credit would be debt going to a private business versus debt going to a public company. It's just the debt side of the equation. And there's all different flavors of that. We've done podcasts on what is debt. You should go look at, people should go look at those. But yeah, generally it just means it's debt going to a private company from a non-traditional bank. So after the GFC, lots of incentives and disincentives for banks to lend to private companies in private equity, often called like shadow banks. They're not really banks. They're not regulated like banks. They have money from limited partners like private equity firms traditional do. So it'd be like a non-bank lender to a private company. I guess you could also, a private credit can invest in a public company. Yeah. But just means they're not a traditional bank. And then private equity, well, you're on the Private Equity Funcast, so everybody should know what that is. Private equity is just the equity side, sits below the debt. And they're all different flavors of equity that we all learned in finance class. So yeah, that's just the major difference.
Yeah. And then throwing out a PE lingo of a double click. Let's, like you just said, there's multiple flavors of private equity. So like private equity buyout, growth equity, VC, like how do you differentiate those in your mind?
Totally. Actually, when we're talking to college kids who listen to the podcast or get to us through friends or parents or things, it's usually like one of the first questions. It's like, What's the difference between venture and buyout? So, and then there's like as many terms for these as possible, and they all kind of mean the same thing, right? So you've got private equity or buyouts or LBOs, right? That's like you're buying the majority of the business. Now, private equity is kind of all of it combined, and there's different segments of it, but generally private equity, I don't know if you guys agree, is like a buyout or an LBO, back in the day. Growth equity is basically private equity, but you take a minority position. So you're not buying the whole company, you're buying a piece of a business. And you're not doing it in a startup, you're doing it in like a real business that's been around for a while. You just don't take majority stakes. And then venture, that's where you get to be wrong 90% of the time and still keep your job. So venture is you're buying very small stakes of very small businesses, and you're kind of swinging for the fences. So I'd say like a private equity fund might have 10 or 12 investments in it in a fund. A growth equity fund might have like 15 or 20. And a venture fund might have like 30 or 50 or 100, depending on kind of what their strategy is. So those are, good questions, kind of like the different flavors of private equity within private equity. And then there's like segments within the private equity world, right? So Liz, like when you think of how you tier private equity into different buckets, like what would those buckets be?
Yeah, I would say like ParkerGale, for example, sits in the lower middle market end of the private equity space, which means we're kind of at this very small end of the market where we buy from founders, family-owned businesses, that kind of thing. The range, like the number on where that cutoff is kind of flexible. Some people would say it's anywhere less than $2 billion, but that's, obviously a very large number. And some people say it's lower than that. So that's where we play. And then there's kind of the mega fund, which is the other end of the spectrum. And that's all your, all the major names that even non-private equity or non-finance people might be familiar with. So Blackstone, Apollo,
KKR.
Yes, all of those guys. So with lots and lots of dollars to invest. And everyone's kind of really doing the same thing, just at a different scale. And it just depends on how big of an investment you're trying to make or how large of a company you're trying to buy. So I'd say that's kind of the range. And then there's
everything else in the middle.
Everything else in between is broadly middle market. So.
Yes. And there's this there's definitely some data that would say lower middle market over long periods of time is more volatile, but maybe performs better, right? It's because they're smaller companies, less efficiency, all that. So whether that's true or not depends on the data you look at. But a lot of people market themselves as lower middle market when they're quite big. You're like, okay, so what are we? Are we like lower middle market?
Yeah.
It's like, well, I'm upper middle class. It's like, well, I'm upper middle class. This is the opposite. It's like, no, I'm lower middle market. So we see a lot of that. And then what's the difference between a firm and a fund? This gets confused too. Like there's firms and then there's funds. So like, how do you think about that?
Yeah, I know like before I joined ParkerGale, the two were kind of interchangeable in my mind, but actually they're separate things. So a firm is, I would think of it as the company. So ParkerGale is a firm that employs people who make investments. Then the funds are the vehicles that you make the investments out of. So one firm could have many, many funds over the course of that firm's lifetime. So we're investing out of Fund 3 right now at ParkerGale, which just means this is the third time they've raised money and need to go invest it. So that's kind of where the word like vintage also comes in. And like, it's literally what it sounds like. It's just like the year in which that fund was, I don't know what the word would be here, incorporated, formed. So, yeah. So,
and you can there could be differences between when the fund was raised or when the fund was activated. So those are different things. You could raise the fund in 2026, but you don't actually start taking fees or investing in it until 2027. So you could make, that might be a jump ball. Some LPs would say, no, you raised it in 26. So a vintage year is 26. Or you didn't start investing in it or activating it, meaning you're taking fees off of it until 2027. That also starts the clock on your investment period, which we'll get to later. Is like once you start taking fees, you have 5 years to invest the capital. So a firm could have multiple funds, even multiple products, debt, equity, other kinds of things. And the fund, there may be ownership of the firm. So maybe one guy owns the whole firm, right? It's, Scrooge McDuck Partners, and he owns the whole firm. But he may have his employees own different percentages of the profits of each fund, right? So Scrooge McDuck owns the whole firm. He's the general partner. And then he has 5 funds, and there's different LPs in each of those funds, right? Different makeups, percentages of LPs. And there's different employees have different equity agreements in those funds in terms of carried interest and stuff. So that might actually have confused people more now that I think about it. But I think we're getting there. Yeah. And I think, why vintage? Because like private equity guys like to collect wine.
Yeah.
That seems like that. Seems like there's got to be a better way.
It's a little bouginess factor too.
I was going to say, exactly.
Yeah,
Well, it depends on what kind of wine you drink, Niko. I know. The three of us were going for the boxed wine here in Chicago. So, maybe the vintage was February.
In this economy?
Exactly. The February vintage of Franzi, I heard, was quite good. And then, I'll grab secondaries. How about that? To get even more confusing. So huge press in secondaries. Obviously, like last year, 2 years ago, private credit was all the rage. This year, last year, secondaries are all the rage. So like, what's a secondary? Well, I guess what isn't? It's not a primary. When we buy a company, we're making an initial investment. That's a primary investment, right? We're taking it out of our fund and putting it into a company. A secondary is when somebody comes and buys a piece of our fund, buys a piece of a company. And there's kind of different ways of that. So let's go LP-led. That's the traditional secondary. An LP-led secondary would be one of our LPs in Fund 3 comes on hard times or changes their strategy or something, needs liquidity. We can't just write them a check and let them out of the fund. That's not a thing, right? We don't have the capital. Our capital goes into companies and pays fees to us for salaries and things. So they may have one LP buys a position from another LP. So say XYZ Foundation says, hey, we had a rough time of it. We need liquidity. And another LP in our fund could say like, well, I want more exposure to this fund, so I'll buy that from you. Now they go negotiate the price and figure all that out. We're not involved in that. The GP isn't involved. So one LP buying a position in a fund they're both in. Now there's LPs from outside the fund. Hey, I really want to get into that fund. Is anybody interested in selling? That's another LP-led secondary. Then there's GP-led secondary, which is the GP is the kind of the lead in the discussion of, hey, I want to do something like a continuation vehicle. We've got a fund. There's 3 companies left in it. We're running out of time. They're all doing great. We want to keep owning them. We don't want to sell them. So let's create a fund. It's like a sub fund of the main fund. So take 3 assets out of one fund, put it in a separate fund. Your existing LPs and new LPs get to decide whether they want to own just pieces of those 3 companies. This is getting so confusing. We're only like 5 minutes in. And then we've done podcasts all on CVs, continuation vehicles. So go listen to that one with the Houlihan Lokey team. And then there's GP stakes. There's entire funds that just buy pieces of private equity firms. Like they buy a piece of the general partner. So just be like selling a minority stake of your business to a private equity firm. A private equity firm can sell a minority stake in their business to an investor who would get a piece of the fee stream over time and maybe a percentage of the carried interest of all future funds. And that would be a GP stake. So that's secondaries.
So what's a GP and what's an LP, which you've dropped 20 times by now?
It's not a general practitioner. GP, general partner, is kind of the team that's in charge of actually managing the money. So it's us sitting around the table. It's ParkerGale here, actually sitting down, doing the diligence on the companies and deciding what to and when to invest in. And then LPs, I view as our limited partners or like our sources of capital. So that could be high net worth individuals. It could be endowments, other institutions, fund of funds. It can really be a broad spectrum, but it's basically our sources of capital to the general partner.
It could be a general practitioner who's got a bunch of money and wants to invest in private equity.
Exactly.
Yeah.
Exactly.
On a GP, you could be a partner in a firm, a private equity firm, but not a general partner, right? So a general partner is like the people who own the firm. Yeah. You're a general partner. But again, managing partner, general partner, all often interchangeable for in most cases. So how do we, when the GP and an LP get together and they have a love connection and they decide to invest, together, how does the GP get paid? We call it 2 and 20. So what's that?
2 and 20, basically 2% of the committed capital from LPs and the managed capital. So the money that we actually put out there, we get to charge 2% management fee on, and that's basically day-to-day, like our salaries, keeping the lights on, rent, everything like that to actually run the business and run the GP. Then the 20%, simple math on it, at the end of the day, when the fund, we sell all of our assets, we get all the money back, hope, we do well, we make a bunch of money, we get to take 20% off the top once on the profits, right? So we distributed the money back to the LPs. Take, for example, we sold everything for 200, they invested 100, difference there's 100, we get to take 20% of that. Simple math. But
totally, exactly. When Jim and I were out fundraising once, we were, I think we were in Europe because they give you those big keys. They have to return back to the check-in desk when you leave. You have a key with a big thing hanging off it. So I was in room 2 and he was in room 20. He was a little in, so we were like, "Oh, this is meant to be." I think we still went 0 for 5 on that trip, but we felt like there was.
But you got a vibe.
There was some seriously good vibes in that hotel. Yeah. That was amazing. All right, so 2 and 20 management fee and carried interest, but you don't get it unless there's a hurdle rate you have to exceed a hurdle rate. So
Yeah.
we're not talking like track and field 2028 Olympics in LA hurdles. Like what's a hurdle rate?
Yeah. Hurdle rate, watermark's another way to put it, right?
Yeah.
Basically, the LPs are guaranteed a certain amount of return, right? So there's an 8%, usually give or take, annual return that compounds. So every year, 8% of their invested capital, boom, boom, stacks up. When we sell all of our assets, we have to clear that 8% compounding before we can actually take our 20% carve of the profits.
Yeah. And so in that fictional case, we were like, hey, we raised a $100 million fund, we returned 200, we get 20 million bucks. If the IRR, right, the net IRR, so after fees, expenses, after all that stuff, exceeds 8%, you get to keep 20%.
Yeah.
Back to zero.
Yeah.
Right? So not
Yeah,
back
dollar for dollar.
Yeah, so all the way back to zero. So there's oftentimes, not on our list, but let's add it, a catch up.
Yeah.
So you pay all the money back, depending on which waterfall you have, which we'll also get to. You pay the money back, you measure it constantly against the net IRR, which is what the investors actually get. You may make a very high return on one investment, but that's the gross return versus the net return to the LPs. You have to take all fees, expenses, and things. So if you're below 8% net, no carry.
Yeah.
Boo-hoo. There was a lot of that in the early 2000s. A lot of funds and a lot of that in 08, 09, 10, as you'd imagine.
Yeah.
And there may be some of that today, given the volatility in the market. So you got to exceed the hurdle rate to get the carry. And then we already covered carry a little bit. Anything else you want to touch on carried interest?
That's basically the allocation of the 20% across the general partnership. So
Totally.
who gets split what?
And each fund, like we talked about, Liz, is different. You might have 5% of the carry in fund one and 15% of the carry in fund two. You might own 0% of the GP because you're not a general partner. You're just an employee of the firm. You don't own it yet. So that moves around a lot in your carried interest. It's a highly negotiated thing when you have a team, and depending on your fund size and your strategy and how you're doing, like, you know, you're negotiating carry with employees from one fund to the next, trying to keep people happy and excited about it. So one way to get to the carry, Liz, me, right? I'm taking this one, is to recycle.
Yeah.
So recycle, good thing to do. Take your garbage out, separate it into two different bags. And now we've got, I think at my house, we have a compost bin. We've got a paper recycling bin. We have a plastics recycling bin, and we just have regular garbage. Do you guys do that? Or do you just have one big pile?
Someone told me they all go to the same place in Chicago, but I don't know if that's fact or fiction. So
Chicago, I do believe everything goes to the same place. So that's a bummer. In the suburbs, we've been told that they go to separate places. Probably not. We'll find out. So recycling is not too different from that. You buy a company. If you return capital from that business within a certain period of time, you get to recycle it into another investment. So this is negotiated with your limited partners while you're raising the fund. Be part of the limited partner agreement or kind of your operating agreement. What you can do is, so right now we have a 24-month recycling period in ParkerGale 3. Meaning, if we buy a company, within 2 years of buying that company, not raising the fund, not activating the fund, so we buy XYZ Corp. Within 2 years, we get money back from that through a recap or a sale or a dividend of some sort. We get to put that money into another deal. So basically, it's like, so say you had a $200 million fund, you had $10 million to recycle. You basically have like 210 to invest, minus the fees and things.
Yeah.
What it allows you to do is you kind of get more money to work rather than it just all going to fees, that 20%, right, that 2% a year. You can get more money to work, which means you can generate more bulk dollars back to your LPs, drive the IRR up, drive the MOIC up, and then maybe have more carry if you're successful. So I think it drives a good incentive. Hey, we're getting paid to put money out and get it back. So if you have the incentive to recycle, it's a good thing to do. Hard to do because usually within 12 or 18 months, you're not like getting money out of an investment, but something good to do if you can do it. I mentioned Waterfalls.
Yeah.
Like, don't go chasing them, I think is what you're not supposed to do.
TLC.
Yes. Before you were born, but I appreciate your musical history. You guys are students of the game. So there's a European waterfall and an American waterfall. So European waterfall, this all has to do with carry.
Yeah.
It's like, when does the carry get paid? In a European waterfall, all the money goes back, plus the 8% compounded return, and then you get all of the carry until you're back to 80-20. In an American waterfall, you can take carry on the first deal, meaning like when you return it. So you don't have to wait for all the money to go back. The challenge with that, the good news about that is everybody can get a little bit of money along the way. They don't have to wait till the end. So I would say mostly for like the younger employees, we were like, hey, you have some carry. We sold XYZ Corp. There's $1 million of carry. Let's spread it around everybody based on your percentage of carry. But if you ever are below 8%, you may have paid out carry early on a great deal, and then the fund doesn't perform. So now you're below 8%. You got to pay that carry back. You can't keep it. You've already paid taxes on that carry. Now they can't claw back what you paid in taxes. You just paid taxes on money you're not even owed. Now you got to pay your accountant to figure that out for you. But like you can get money in an American waterfall that you actually haven't earned yet, and it could be clawed back from you by the limited partners. That's painful. Really painful for the junior employees.
Is that specific to the firm or to the fund?
The fund.
Right. So you could have 3 funds and one is European, one is American.
You could, yes, you could have different arrangements per fund. My guess is once you go European, you never go back.
Real.
Exactly. So just because American is aggressive, I mean, it used to be the only way. I'd say today, maybe a little more aggressive. And oftentimes it used to be like, hey, we'll deal with the clawback at the end of 10 years, right? You paid out the carry, you didn't earn it. After 10 years, we check, you owe the LPs $10 million. Painful. Because you may have bought a house with that carry 7 years ago. You may have, put it in a 529 account. You got to come up with the money. What's happening now is LPs will put in like checkpoints along the way. Okay, you can have American waterfall. You can pay out carry early as long as you're above the hurdle rate. But we're going to check at year 2, year 4, year 6, year 8, year 10. And at any point along the way, if you don't pass it, then you have to do it. We're not waiting until year 10 or 12. So that's maybe a little different. And that happens at the fund level, meaning like it's not on all the funds. You may have an absolute banger of a fund that blew out the hurdle rate and paid a lot of carry, and then your next fund has a clawback. So it's all fund by fund. And then the risk is like you're investing into a blind pool. So blind pool, another Blind Melon, okay band, couple hits, tragic end to the band, to the
Stretching my music knowledge here. But.
Yeah, I guess. So, all right, you got TLC, but Blind Melon. I mean,
crickets over here.
Exactly. Yeah, it's a total unk move to bring up Blind Melon. But so a blind pool is a private equity. When you commit to a private equity fund, you don't know what they're going to buy. Now, there's cases where they've already made 1, 2, or 3 investments before they do the final close in the fund. So sure, the late investors get to see a couple of the assets in there, but they don't know when they commit to the fund what you're going to buy. Where if you bought a mutual fund or an ETF, you know exactly what's in there.
Yeah. Right.
So that's a challenge. How about the way you get the money is a capital call, right? So capital call is, and this is something a lot of LPs don't know.
Yeah, and I didn't have an appreciation for this too.
Sorry, LPs know this. A lot of new people into the industry don't know this, which is, when we raise a fund, we don't have all the money sitting in the bank. And then we, call the bank and say, hey, send us $10 million. What we do is they hang on to it. They keep it in their mind and on their accounts. We owe ParkerGale $20 million over the next 10 years or 5 years or however long. So they know when we need it. So say we had that $100 million fund and we invested $10 million into a company. We send out a notice to all our LPs and say, okay, I need 10% of your capital. And that's what a capital call is.
Yeah. And I've heard this phrase dry powder tossed around as well. And I think that's also relevant here, where basically it just means the amount of dollars you have left in your LP's bank accounts that you haven't yet called. And so when people are talking about their next investment or a current investment where they're looking to do some add-ons or maybe do some other investments, the partners will be like, how much dry powder do we have left or whatever? And it basically just means how much money do we have left to call. So
Dry powder could be a great thing, Niko. And when you're in Utah, skiing the slopes,
True.
Nice dry champagne powder. Yeah. Dry powder could be an amazing thing. When we have all this dry powder, we could buy whatever we want.
Yeah.
And then dry powder could be a bad thing. There's so much dry powder in the industry. How is it going to be invested?
Yeah.
And that's a question a lot of people are asking themselves right now. There's so much money in private equity and private credit looking for a home. There's so many companies still left to be sold, 32,000 private equity owned companies needing to be sold in the next handful of years. And there's a lot of dry powder, which means money that's been committed to a fund, but not yet called. Where are they going to put it? Maybe in a ski mountain in Utah. And they can have use their dry powder to buy some dry powder.
Yeah.
It's a conundrum.
More dry powder. So I said, like, you've got time to invest it. Well, what's the investment period?
Yeah, I think, each fund has 5 years to make those initial platform investments. I think there's a longer period to do like add-ons and such for those existing platforms, but you have 5 years to invest the money. And then what happens to the money that's left over if you don't invest it in those 5 years?
You don't call it.
Yeah.
So then you would just run the math. So we had a $100 million fund. I only invested 70 million of it. I took 15 million of in fees. So I've got uninvested capital. I know what to do. So you never call it from the LPs. Makes it harder to get to the hurdle rate, harder to get to the carry potentially. It's like also I think the LPs would say, did you raise too much money? Maybe you should have only raised 80 if you could only deploy 70. You made a really good point, which is you have 5 years to invest in platforms. So new companies, right? So you're going to make 10 investments in a fund. And you have 5 years to find those 10 investments and make those investments. You can do add-ons along the way, but after year 5, you cannot make an 11th investment. Mm-hmm. You can make as many investments as you want into add-ons, which we'll get to, tuck-ins, add-ons, all those things, bolt-ons. You can use all the money you want for that. That's left to be called the dry powder, right? That's what your dry powder is for to pay your fees after year 5 and to pay fund add-on investments. But you can't make a new investment after year 5. Now you could go and ask for an extension, like after 2001 and GFC. People say, "Hey, it's a really hard time to invest. Could I have another year to deploy this capital?" I think most LPs in a great relationship would be like, "Sure, another year's fine." I think in a time like now, where it was like, "I want my money back," and I kind of don't. I have too much uncalled capital, right, sitting on my balance sheet that they haven't called yet. I'm probably going to say, "No, we're good." But it'll be case by case basis. Yeah. And then the problem we talked about a little bit is if you don't invest in the investment period or you make bad investments during the investment period, if you took carry early in an American waterfall, this doesn't happen in a European, highly unlikely in a European waterfall that you'd have to pay money back, just given how the sequence of operations works. You could have a clawback, which is, hey, we paid out too much carry. You owe us money. Not the firm, the people who had carry in the fund. Mm-hmm. So you could be a 28-year-old VP, gotten a $100,000 check the second year of the fund. You went to business school, went somewhere else. You get a phone call when you're 32 years old. I need $25,000 back, right? Now they can't force you to do it. Little secret.
What do you mean?
You can say, "I'm not paying it back.
Whoa.
I was a VP. You gave me carry. I spent it on business school.
Money's gone.
Money's gone. I don't have the 25K. So what happens is the GP has to come up with it. So if you finked on 25 grand, I'm on the hook for it. Right? It would be maybe hard to get a job in the industry if you didn't do that. You may not care, but that is also the risk of how you structure your firm and kind of who gets the carry and all these things. Is in an event of a clawback, I could go to my LPs and say, "Hey, we're 25,000 short because this guy wouldn't pay it." I think they would say, well, you should pay me. And I could say, I'm not going to. I think my LPs wouldn't be very happy with that.
Yeah.
But multiply that by 10 or 100
Yeah.
when you get to these big funds.
Sure.
It's a real issue. And that's why you might have a zombie fund.
There we go.
What is that? You might be a redneck if. You might have a zombie fund if. If you've got a huge clawback coming your way, and a lot of things that happen in the funds that maybe aren't going to make it or have another fund afterwards, it's called a zombie fund, meaning they're kind of hanging on to everything to try and get back above that high water mark, above the hurdle rate to get to some carry, or to not have to pay a clawback. So this is one of the big concerns an LP has is they're in a fund that's never going to raise another fund. Maybe because everybody's retiring. Maybe because their track record isn't good. Maybe because they made a lot of mistakes and they're not going to be able to raise another fund. But they have a $5 billion fund that's 80% invested, and there's never going to be another fund.
That 2% on it too, right? While it's out there, or no?
Yeah. So you charge 2% on it on committed capital for the first 5 years, and you charge 2% of invested capital afterwards. So that $100 million firm we talked about, they're getting $2 million a year for the first 5 years. If they've only invested 50, after year 5, they're only getting 1% or they're getting 2% of 50.
Yeah.
Right. So big difference. So $1 million if my art major math is correct. So they don't have an incentive to sell something. So you sell a company, and maybe that was $10 million. You just lost the fees on that because it's no longer invested. It's been sold. So this is a concern of LPs in funds where maybe you don't think there's a future here, and people are just hanging on to investments to kind of make that to keep the fees going.
Yeah,
and their incentive is to just get above the hurdle rate or whatever it is. All right, I'm tired after all that. Let's jump into like deals and stuff.
Yeah.
Like, what are the words people use to describe when they're in the middle of a deal?
Yeah.
So
how do
one we
deals?
love?
Yeah, how do deals come to a firm?
Yeah, and there's kind of two avenues on how we source deals here, and I'm sure pretty much the entire world sources deals. There's the proprietary avenue, and then there's this auction process avenue as well. And proprietary, Devin knows anybody and everybody out there, and hopefully one day gets a call. Hey, I know this guy who runs this great software business, looking to retire. I think you should take a look at it. And we get to communicate directly with them. So no middleman. We own the whole process. Gets to build much more of a familial relationship with the founders and management team, and proprietary in that it's just us looking at it. And then there's these auction processes, and it's kind of back to my previous job. Like, you hire an investment bank, you hire a business broker who acts as an intermediary between the business so that the management team can focus on running the business. And then these guys can reach out to private equity folks like us and send around a word we're going to dive into: SIM, SIP, executive summary, memo, business memo. But basically, proprietary, you own the relationship. You're talking to them one-on-one. Auction process, there's a middleman facilitating the deal.
Proprietary is a term that LPs hate.
Really?
Because everybody overuses it.
Oh, I'm sure.
Oh, this is a proprietary deal, proprietary. We just call it direct because we don't want to. It's like, how did this deal come to us? It was direct relationship with the owner. Only because we don't want to use proprietary because LPs just start rolling their eyes when they hear it. But there's different flavors of auctions too. Yeah. Right. So there's like, you could do fireside chats.
Yeah. Little FSC action.
FSC. What's the FSC?
It's probably a 2-hour-long Zoom call that is virtual, spread all over the United States.
Is there a fire?
There's no fire. Maybe someone's background, but
can you at least have like your Zoom background be like the Yule log from Christmas?
Fireside.
Yeah, just build a little aesthetic in there.
Yeah.
But basically, it would be us three, how we're talking right now, but asking a management team questions about their business, how they're making money, projections, who's doing what role in the company, basically getting a better understanding. And someone told me it's called a fireside chat because it's supposed to be intimate, like a one-on-one conversation next to a fire, but
wow.
Take that for what you.
And what's the difference between a fireside chat and an MP? An FSC versus an MP?
FSC is like historically how I was taught was like 90 minutes. MPs are 5 hours.
So that's full blown. Bring
Full-blown,
everybody.
Everyone's coming.
Okay.
And it's like, we're diving in here full go.
Fireside chat also seems to be an innovation of investment bankers to let a private equity firm or a interested buyer in like, hey, we're doing fireside chats.
Yeah.
Which means we're not going to a lot of people.
Yeah.
Right. But they may have done 30 fireside chats.
Totally.
Right. But they might have done 3. It feels like you're getting some inside scoop here.
And it goes like that intimacy level is a little bit more there than, hey, we're doing MPs next week. What hour can you make?
And the deal, and this is like a post-COVID thing, is they've turned into Zooms. It used to actually be like, hey, don't bring your whole team. Bring like the partner and the deal lead, and you get to meet the CEO.
Yeah.
And now it's like a fireside chat could be like 20 people on a Zoom.
Yeah.
Yeah, totally. But you're not going deep.
No,
This
you're
is like getting familiar with the business.
inch deep, mile wide kind of thing.
The firm gets to demonstrate we know a lot about the business, and I really like those guys. All right, so first comes the, there's proprietary or not, or it's auctioned or intermediated somehow. You got to come up with a way to describe the business to people. So we've had this argument internally, like SIM versus SIP versus business plan. Like me, when I was an associate, we had business plans. We'd get a document. It was like a 40-page written document with some charts and graphs and stuff. But that was a business plan.
Yeah.
And then it turned into like SIM, which I still have trouble with. And then it was you guys call them SIPs.
That's what I learned originally was a SIP. So confidential information presentation versus confidential information memorandum.
Yes.
And memorandum just has this like, I don't know,
Fanciness.
little irk to me is like,
Really?
yeah.
You think it's like somebody like typing something in the 50s?
Yeah, kind of like the typewriter right here, just like typing things out and maybe print it off one of these computers here.
So
but
presentations have charts.
presentations a little bit more
and
slick in my
Harvey
mind.
balls and-
Yeah, but here we refer to them as Sims, so maybe we just have a little more vintage to us.
Well, it's because we're old.
Well,
That's why.
it
Because I didn't
comes
know it
from
was
the
called
banker. It's whatever they put on the
That is
PDF.
fair.
It's
That
what
is
it
fair.
is. However they
I would
label
say
it.
it's the aspect ratio.
Oh.
A sim is portrait,
Yeah.
and a SIP is landscape.
Yeah, that's not true for like 99, actually 100% of the.
When's the last sim
no.
or SIP or business plan, whatever
I
we want
think
to call
I've
it?
seen maybe like 3 vertical ones in Word doc form and then hundreds of horizontal.
Yeah,
That is relatively new.
Yeah.
I mean,
that's all I've known.
It's all PowerPoints.
Yeah,
Yeah.
All right, so they're all the same thing.
they're all
They're all
the
the
same
same
thing. They all say the same thing.
What does the business do? Who are the
Yeah.
competitors? What do they sell? How do they make money?
Here's the management team
Who's
page.
running it?
Yeah.
Right.
Et cetera.
Again, that inch deep, mile wide overview of the business.
Adjusted pro forma run rate EBITDA.
Normalized.
Normalized.
with synergies recognized.
Retention asterisk, read the small print.
Yeah.
Does not include our major customers who've churned in the last 12 months. Stuff like that. All right. So then you have the SIM SIP business. I'm going to call it the business plan because I'm old. So you get the SIP, you have the MP. Now you have to tell them what you want to pay for it.
Right.
There's like two layers of that. There's
Yeah.
an IOI and then an LOI. What are they and what's the difference?
Yeah. IOI is like indication of interest. And this is kind of like right after maybe an FSC, you got to know the management team a little bit. You got to learn more. It's kind of like, hey, let's go on a date. Like, this is what we think you're worth. These are kind of the diligence factors we need to think about. And basically in an auction process, like this is how those intermediaries, those investment bankers get to determine who they're going to bring along to that second round of the process, who they're going to really open up a full-blown data room, all the financials, customers, give up more time of management for calls. And then after IOIs would come an LOI. So IOI, you have about 2 weeks to digest more data. LOI is like, hey, this is like what Liz and I just went through. We got engaged. We're proposing.
We are not engaged.
Yes, sorry. To
Separate
clarify.
people.
Separately
Yes.
not
Good.
engaged.
That is actually a good point.
Hey, I met my wife at work. No shade.
Yeah. No. LOI is like engagement. So this is, hey, we've done this amount of diligence. This is what we learned. It's much more of a baked number on this is what we think Devin Matthews Corp is worth
Yep.
$100 million. And then asterisk on it, still contingent on us completing these diligence processes. So financial diligence, we'll get into a little bit later about a QOV, commercial diligence, again, there's a customer cube, stuff like that. But basically LOI, engagement, IOI, hey, let's go on a few dates here and figure out each other a little bit more. It's kind of how I view it in my mind. I don't know if you guys disagree
and not
with that.
every process has both.
No.
Right. So some will just go straight to we're taking LOIs. Like there's not like a 2-step dance here. But I think it kind of depends on the seller, what they want, and the bankers, how they want to play it.
Yeah.
But
So in an intermediated process, auction or whatever, you're using the IOI to weed people out. Hey, tell us basically what price would you pay?
Yeah.
Do you have the money to do it? How much more work can you need to do, basically?
Yeah.
If somebody says, I'm at this price, I need to go raise the capital because I'm an independent sponsor and I've got a ton of work to do. You may not make it.
Yeah, lower. I remember, like we hear it now in our processes. Some people blow out valuation on IOIs, but then you could look in a data room and see they haven't downloaded anything. So like you have to put a little bit of grain of salt to everything on the amount of work actually done, and
blow up meaning they come in at a very high price,
but they haven't
they're
done
not
any
doing the
work, right? So that number can be
it could be meaningless.
nothing. Yeah, exactly.
And every investment bank has a list of behaviors.
Yeah.
This firm bids high and always comes down low.
Totally.
They bid on everything and they never finish. Or would they bid and they close on those terms, right?
There's like there's like a personality around it.
All right. So that's kind of outwardly. We want to buy a business. Let's put the LOI together.
Yeah.
And then we got to go to IC.
Yeah. Investment committee.
Okay. So what happens in an investment committee meeting? Like what stage of the process is that? And where is it happening?
Yeah. So, I mean, we're filming here in ParkerGale's office. Our IC meetings happen here. Basically, deal team circles up, pulls together all the materials that they've learned on the business. So financials, at this point, there's, future projections, sources and uses. So how much equity are we going to use? Are we going to go out to private credit firms to get some debt on the business too, to help us out a little bit? But basically just synergizing all the information we gathered, and we get to present to our IC, our investment committee. And at the end of the day, this is kind of like meeting of what's it called in Lord of the Rings, where they all the circle,
council.
The council,
Yeah.
basically give yay or nay on how things stand, and get to interact, and members who aren't on the deal team get to ask questions that maybe people aren't thinking about because there's a little blind side in this to being so far into it. I view it as a good way to elevate when you're so far in the weeds, elevate out and actually make sure everyone's understanding and on the same page of things.
Yeah, and depending on the size of the firm, there may be multiple layers to the IC, right? There may be preliminary and then final. But like the final IC is we're all voting at the end. Are we doing this deal or not on these terms? And you're probably within weeks away from closing, not months and not days.
Right.
Because if you gets voted down at the IC,
like you said, that personality of like firms, you don't want to bid on something and then not act on it. So
totally. So there's a lot of diligence that's happening that goes into this IC meeting, right? That you have to present. One of which is a Q of E.
Yeah. So the quality of
What the heck is a Q of E?
Right. Yeah. So when we're diligencing a company, you'll have multiple work streams that you need to engage in. And one of them is the financial due diligence, which essentially involves hiring an outside firm to come and scrub the numbers and pull together a quality of earnings report where they kind of go through every single journal entry and piece together kind of like what's the financial picture of this company.
But didn't the bankers already give you the financials of the company? What do you need a Q of E for?
Yeah, so you can't trust everyone all the time. So of course, benefit of the doubt is great, but also as, people who are going to be ultimately responsible and owners of the business, you want to make sure you have a third-party neutral source that can kind of go in and verify everything that's been provided. And so that process, takes usually a few weeks, depending on how fully baked the company's existing financials already are and what their accounting process looks like. And so the deal team is pretty involved, at least here, in that process and understanding all of the different parts of that report are very important to understanding the business.
So we've been given all the information. We've done all the work ourselves, and we are hiring a third party to now validate the work that was given to us, the work we did internally, and you put a stamp of approval on this is what it is. And there's always something that comes up in there.
Totally.
Hey, did you know this about taxes? Hey, we couldn't verify this invoice with this revenue rec thing. So there's always kinds of cleanup and things. Also, your IC cares, did you do a Q of E?
Totally.
And who did we use? And if you're raising debt, they 100% need to see that there was a Q of E done, because they're not just going to take your word for it.
Yeah.
Right. All right. So how about, I just learned a new term yesterday, a Q of R.
Oh,
Literally,
that one's new to me too.
I know. I was on a phone call. I was like, well, we did a Q of R. And so then I was like, what does that mean? And they're like, oh, quality of revenue. So is there any difference between, what would we call that, and what are the other names for a Q of R?
Yeah. So what we tend to refer to that analysis as is a retention analysis, and at least in the tech software world, or a customer cube, which essentially is going through every customer and seeing, what's the pattern of their revenue, how often does it come in. So in a subscription business, you would expect to see monthly charges of the same amount, or an annual contract that when you divide it by 12, it's the same amount every month. So how those customers' revenue changes each year or each period kind of gives you a picture of like, are these customers sticking with you and buying more every year, or are they, are you getting less and less out of them every year because they're not happy with the product or they're not happy with the customer service? And it tells you kind of in a more three-dimensional way, like what is going on with the actual customers in the business. For us, that just means a lot of Excel and number crunching and going through invoices and, tying all the invoices to each customer.
Like literally going through invoices.
Yes, literally every invoice, every refund should be applied to the relevant invoice. And if there's no invoice, then that's a question for
Why do people call it a customer cube? Is it three-dimensional?
I asked that same question. My understanding is that it's, multi-dimensions for the customer. So not just how much money, but also what products and what terms and all the other things that you might want to slice and dice the customer data on is all included in this one gigantic file. So if anyone asks any question about any customer, you just pull up that one file and everything's in there.
Yeah. It's, for us, the most important thing.
Yeah.
If we're buying a company and selling it, and it can get really hairy. Well, it oftentimes comes to us pretty hairy because we're dealing mostly with founder and family-owned businesses. But even after we've cleaned it all up and we get going every day without maintenance and care, that thing gets uglier and uglier. So if you don't pay attention to it every day, even after we own the business, it's kind of a bear to fix. So it's something we take very seriously and really need our management teams with our help just to get it right and to keep it nice and clean. And then we got to run comps, right? AC wants to see what the comps are. LPs want to know what the comps are. The auditors want to know what comps we're using.
Yeah.
So what the heck are comps?
Yeah. So comps is just, cool person slang for comparables. So anything that can give you a temperature check on, this transaction. So what did other similar transactions quote trade at? What price did they clear the market at? What did other people pay for something very similar to this? And that helps kind of auditors and also, the investment committee get a sense check of like, hey, are we way undervaluing this or are we way overpaying for something like this? And it, gets you into the right zone that you want to be in. And then there's comparable companies, there's comparable transactions. So transactions obviously is other companies that have recently been bought or sold, and comparable companies, usually this is referring to public companies that have a stock price, and so it's public what they're valued at, and you would find those similar companies and compare them against the one that you're looking at.
Can we just all grab the comps from like the fall of 2021 and use those to value our businesses?
No, the MD or whoever you're working with would be like, these are stale. Those aren't even stale. Those are
stale comps. Those are dusty.
Rock hard at this point.
They're petrified comps at this point. it is an art, not a science. People want to pick the lowest comps when you're buying a business and show the seller, hey, look, these businesses don't trade like this. These are the perfect comps. You're using the wrong comps. And then when you're selling a business, you want to use the prettiest comps. So it is a negotiation. You have to show your work, and you can argue about whether you have the right comps or not. But if the comps don't come in good, it's a perfect opportunity to retrade, right? So, or give it a haircut, right? I've got a haircut scheduled for Saturday morning. But a haircut in our world is you're going to cut the price. I would say some firms have reputations for loving cutting price. We'll come in high and we're going to find a reason to cut the price. We want to get our arms wrapped around it, get everybody deep in a process. Walking away is too hard, so we'll probably be able to chip the price down, give it a haircut, retrade. I'd say haircut everybody likes a good haircut, but a retrade is bad, but they're the same exact thing. Now, sometimes you need to give the deal a haircut to make it work. Maybe the business didn't perform during diligence. Maybe something happened and it deserves a haircut. You'll be told you're retrading, and how dare you retrade me? You say, hey, you missed your numbers, and we're still going to buy the company. But we need a little something for the effort. So let's cut the price a little bit. You never want to be in a position where you have to retrade because it means you missed something. You were too optimistic, or you're being tricky. Is that fair?
Yeah.
All right. Should we talk about returns? Like what happens after all this stuff happens? We bought a company. So we think there are lots of ways to talk about your returns. You got gross IRR, net IRR, IRR. When sometimes you say IRR, is it gross or net? A lot of people care about gross, like we would care about gross. Our LPs only care about net. Management team doesn't care about net or gross. Then you got MOIC, which is the multiple on invested capital. We invested $100 million in this company. We returned $300 million, right? So that MOIC is a 3x MOIC, multiple of invested capital. Now that's a gross number. Your LPs don't get $300 million, right? They get something else. They have a net number because they've paid fees and other things into it. And then, there's all kinds. RVPI, TVPI, DPI. We can get into all these things, but this is probably for a different conversation. And then, but how are those things valued? Like revenue, EBITDA, like how do we talk about that kind of stuff?
Yeah, and this kind of goes into multiples. So when we're exiting a company, let's say it had 10 million of revenue and we're selling it for 7 times revenue or 7 turns of revenue, right? So that'd be 70 million bucks, which then turns into hopefully, you bought it for 10 million, you sold it for 70, simple math here. That's a 7-bagger, right?
Yeah.
Bagger, really great. Don't really talk about your negative ones in terms of baggers in my mind, but
exactly.
Why is it called a bagger?
Because baseball.
Oh.
It was
I thought it was like stuffing money in the bag.
Oh, really?
Yeah.
See, this is great. Why we're having this conversation. I think of it as like, if it's a triple, that's a 3-bagger. You touch 3 bags, right?
That's good.
You could also be like, Scrooge McDuck stuffing money in the bag. But you don't talk about your 1-baggers.
Yeah.
2-bagger. Hey, in this market, people will take the 2-bagger. 3-bagger, now you're talking a 4-bagger. That's a home run. But then you get 5, 6, 7-bagger. Like that's not even a sport.
Exactly.
What sport has 7 bags?
Stuffing the money
Just
in the
running
bag.
around in circles.
Now you're just stuffing money in the bag, I think, at that point.
Right.
Getting to that 5-bagger, like everyone likes to talk about multiple expansion. So we bought it for 5 times revenue, and then we're selling it for 7 times revenue. So hopefully in that time, revenue obviously grew. We did our job. We'll get to it later. We created value.
Yeah.
And now we're selling it for more based like P times Q. Our P and Q both went up. So
amazing. I don't know what I don't know what that means, P and Q, but I'm going to go with it. I think I'm following it. So how do we get to this return, right? You could grow organically or you could buy stuff.
Yeah.
So there's all kinds of terms for when one private equity company buys another business in an acquisition. So all of them mean the same thing, but they're different words. So what are all the different words for that?
So if you're doing a roll up, it means you're buying a bunch of stuff and putting it together. And
you start with a platform.
You start with one. You start with the platform.
And that's the platform.
Yes.
That's relatively new too. I never call it, 20 years ago, we didn't talk about platforms. We talked about add-ons, but it was just like the investment. But now it's platforms. All right, so it's a platform.
It's a platform, and then you can do add-ons, bolt-ons, tuck-ins, consolidate the market. You can buy versus build, which means instead of
you could roll up
reinventing the wheel, we're going to buy somebody else's wheel and put it in this car. It's all the same thing. It just means, inorganically growing the company by buying other companies.
Yeah. Is there a difference between a tuck-in and a bolt-on? Those seem different to me, but I can't articulate it.
Tuck-ins are like really small and you kind of just fold it right into the existing business. Maybe its name goes away and it rebrands under the existing company you have, and kind of any other personality it had maybe fades away slowly. Bolt-on maybe feels a little bigger.
Bolt-on to me, I view as like extending the business horizontally. Tuck in, like more of the same. Bolt-on's like something net new. And then maybe tuck-in's like a little growing different. Your customer base, selling the same thing. That's how I view it.
Amazing.
Works with me.
Can we add net new to the list?
Net new.
All right. So real quick, then how do you kind of get the money back? There's a dividend recap. We talked about that, right? So you're recapitalizing the business, meaning somebody is coming in, maybe a lender, maybe another private equity firm. They're buying a portion of the business and you're giving your shareholders ownership, a dividend, right? So there's a dividend recap. Very important in a recap. So we get called a lot. We buy small companies. Bigger funds say, hey, I really like that business. We could buy 30% of it. You could take some money off the table. You own the majority of it and you'll extend your investment period, hang on a little longer. In those situations, like that's a recapitalization. It's very important to be pari passu, right?
Not going to lie, when I first started in finance, I thought pari passu was like a fancy French dish.
like tiramisu.
Exactly. Yeah.
Tiramisu all day long.
Yeah.
I don't know. I follow some woman on Instagram who has like a drawer in her fridge that's just a tiramisu drawer. Like makes it in the fridge. That's pretty baller. Pretty baller. But I agree. I still can't even spell pari passu. Is it 2 R's and 1 S? Is it 1 R and 2 S's?
There's a hyphen in there.
There's a hyphen in there. Yeah. So pari passu just means you're equal to in terms and valuation and other things as other investors. So you would want to be pari passu.
Yeah.
If somebody came in a recap, gave you $50 million, you would be like, well, that 50 could go on the top of the stack, or it could be pari passu.
Yeah.
So top of the stack means you're the first money out. The lender, top of the stack. There's no debt, the preferred shareholder on top of the stack above common. There may be multiple layers of preferred. There may be different investors in those. So important there that you can be pari passu, and we can all come up with a better word for it. And then you want to get out of the J curve as fast as possible. J curve just means early in a fund, even sometimes early in an investment. If you're spending down EBITDA, like you may be in the J curve. So it looks like a J. Hopefully you got that hockey stick at the end.
Yeah.
But the J is, when you activate a fund and you call fees, first thing you do, that's how you activate a fund. All right, I need $5 million to pay the bills. Okay, so you -5, you haven't made an investment yet. So your IRR in that fund is negative. And then you got to get out of the J curve. The only way to get out of the J curve is to create value in your portfolio companies. All right, so let's bring this home. And let's just talk about like finance bro speak that we just don't like. Is it fair to call it finance bro speak, or is it gender neutral?
No, mostly it's finance. It's finance bro speak.
Okay. All right. So women in the industry are not using these terms, or at least they're not using them seriously. They may be using them ironically.
Yeah.
All right. So who wants to take the first one?
Yeah. Then we
value creation. What is that?
Creation. This is this great thing that private equity brings to the table. Everybody does it. And at the end of the day, like I view it as us coming in and cleaning up a bunch of systems and processes, doing things that the original management team wasn't necessarily doing. But it sounds way cooler when you say value creation, and everybody talks about value creation.
You have to have a value creation plan.
Yeah,
a
it
VCP.
has to literally be a deck.
Yeah, a deck, which I just think of as a PowerPoint or a presentation. Yeah. But you hire a consultant to create value. They're going to put a deck together.
Oh, totally,
totally, and they're going to put a deck together showing you how they're going to create value.
Yeah, which is in your white space. If you didn't know this, not to be confused with blue ocean and red ocean in your white space.
You need white space. How do you create value without white space?
Yeah, you need to go get more.
More white space?
Yeah.
How do you create more white space? A bolt-on.
Bigger TAM.
Bolt-ons,
Yeah.
add-ons, TAM expansion.
Yeah.
I would say value creation to me, why is this finance bro speak and annoying? Everybody in our industry use it. Nobody at a company, no CEO, CFO, head of sales, CTO, ever thinks they're a value creation.
Right.
They're like, I'm just doing my job.
Yeah.
Like I'm turning knobs, I'm typing on the computer, I'm having meetings, I'm driving, some initiative. That's why it's funny, because like what value does private equity create from, sitting in an office building 500 miles away from the company?
Yeah.
The company is doing the work. We just like to create value. I've never seen value that I didn't want to create. I'll say that. I haven't seen EBITDA I didn't want to adjust.
Yeah, totally.
All right. So we're creating white space.
Yeah.
That helps create more value. You got a lot of, you got brownfield and greenfield.
Yeah.
You need white space. You got blue ocean versus red ocean.
Yeah. Blue ocean. Again, this also is so confusing to me. Blue ocean just means new customers who don't have something that you're selling, right? So selling something new to people who don't have it.
Net new
Exactly.
customers.
Red
and,
ocean.
And not very competitive.
Yeah.
It's a space where you've got a lot of
It's
white
undermined.
space.
Yeah.
You got a lot of white space in a blue ocean.
Yeah.
And what's red ocean?
I view red ocean, maybe I'm totally wrong, is like rip and replace. Like you're going up against your competitors and you're getting quote unquote competitive takeaways. So
Red ocean, highly competitive market, lots of competition.
And it's red because there's blood in the water.
Exactly.
yeah.
Chum is just getting devoured by the sharks.
Wow.
All in the effort to create value.
Right.
I mean, blame
It's
value.
a noble mission. It's a noble mission.
Blame value creation. Don't blame don't blame the operating partner. All right. Well, what's really important when you're creating value?
Well, you have to de-risk the plan, of course. So honestly, I don't know what de-risk means. It just means, like, is it different than mitigate in any way? Or is it just,
No.
okay.
It just sounds better than mitigate.
De-risk, yeah.
We
Unrisk
got to
it.
de-risk this.
Yeah.
It's like deplaning. Why do you deplane? When you get off a plane, you're deplaning.
Yeah.
Just de-risk, you deplane. Whenever we put D in front of anything else?
Delight.
Yeah.
I don't know.
But it's not, there's no hyphen. You deplane, you
Right.
de-risk, you delight.
Yeah. De-risk, I don't know. It just means do some stuff to make it less risky and make sure you're addressing it.
Well, in the IC, you better have answers to how you're going to mitigate and de-risk
Yes.
some issues.
It's important.
Hey, DRAM costs are going up. How do you de-risk that? Right?
Yeah.
Cloud computing costs are going up. Hosting costs are going up. We got to de-risk the plan. And that's a new way to create value if you
Yeah.
de-risk it.
But what's really going to move the needle here?
That is, what will move the needle?
Move the needle.
Do you know what it's not an actual needle. It's like the needle on like the volume.
Like
Yeah.
You need the volume needle to go up, right?
Yeah.
Yeah. So, all right, we got to move the needle, but the way you move the needle is you have to have something to move the needle.
Got to have a unique angle
Yeah.
or a strategic angle or something.
And a great way to kill a deal is,
We don't have an angle.
Yeah.
Sorry.
how many times have you written in an email to a banker, we talked about this one, we really liked it, we just don't have a unique angle to
Unfortunately.
be competitive.
You're exposing us here.
It's just a very nice way to turn a deal down.
No, it's
Yeah.
such a perfect catch-all
Yeah.
because
Yeah,
it's
'cause you're like-
accurate every time. It's not too specific, and it's like it's accurate.
Because you can't just have an angle. You need to have a unique
Yeah.
angle.
Yeah.
A unique angle. And then you say, I love this deal, even if you don't.
Mhm.
I wish we could pursue it. We just can't be competitive because we don't have a unique angle.
Mhm.
It's on us.
Yeah.
If only we had more unique angles around here, we could pursue more deals. But one way to have a unique angle is if you just do some basic blocking and tackling. How
Yeah.
about,
I have a vendetta. I
how-
have a vendetta against this
As
one.
the resident football
Yeah.
player here.
Basic blocking and tackling is really hard
Is it
in
basic?
real life.
Why
like,
is it basic?
I-
It's
but
90% of our day.
being a former offensive lineman, everyone thinks we're the dumb guys and it's very easy to do and we're just kind of out there doing our thing. But yeah, when I'm in a room and I hear basic blocking and tackling, my guess is it's actually really hard to go do. So it kind of
Yeah.
just runs chills down my spine.
Because some guy who creates value all day at a private
Yeah.
equity firm just tells management, hey guys, it's not hard. It's just basic
Yeah,
blocking
we
and
could
tackling.
grow 80% this year if we just do the basic blocking and tackling. Yeah.
Amazing. All right. So when I hear that in the next meeting, I'll make sure I'll know you're triggered.
Yeah,
When you get up to use the restroom.
As I go off camera real quick. Yeah.
Yeah, you're like hyperventilating into a paper bag. But there's one way to do basic blocking and tackling is you pull the levers.
Yeah.
That's pulling levers is basic blocking and tackling, isn't it?
Yeah. This is in my head. I have like, whenever I hear we just got to pull the levers, like I picture like a henchman pulling a lever and like the trap door falling. But yeah, like levers are just, again, like executing the basics of the business and the plan of the business. But we can't just say, hey, we're going to do the plan. We're going to pull these levers to get here.
Are all levers the same size?
No.
Yeah.
So which levers do we?
There's some quote that's like, if you can move the world if you just have a big enough lever,
Exactly.
or something like that. So some are small and some are world moving large. So
Yeah. What's the difference between a lever and a lever? Some people call it a lever. Yeah. So so you got to have a lot of levers to pull.
Yeah.
We got a lot of levers to pull to de-risk this deal.
Mm-hmm.
And if we do that, we're going to create a ton of value in the white space we created through all the bolt-ons we did.
Yep.
Is that even English?
Yeah.
At this point? All right. But hey, at the end.
Yeah. I mean, what's the result? Net, you know, net. You can't just say it one time. It's gotta be twice. Net.
Yeah. So there's net new. Which
new.
To me is always confusing. It's like net new.
I think that's the same
it's
thing
just,
as
I think
new.
that's just new.
Yeah.
And then net is just net.
Net.
But is it like net? Like there's net income and then there's something
every time
below
someone
that?
says that, I think about it for the next 3 minutes, like in the whole conversation. I think it's like net for whatever you're putting in and net for whatever you're taking out.
Yeah. Oh, so it balances out.
So it's like
net.
There's two things getting netted.
Oh, it's two sides of the
Maybe.
lever.
Yeah.
Yes. Yes.
Two sides of the lever balancing each other out. Net.
Yes.
We're the same.
We're the same.
Net, nothing.
Exactly.
Changed. Yeah.
All right. Net, nothing changed.
Mm-hmm.
Okay. And then this is one of my favorites.
Quantum. What's the quantum?
The quantum. Usually you only use for debt though.
Yeah.
You never talk about the quantum of equity or the quantum of potato chips.
Cash.
Quantum of cash.
Revenue.
Everybody says
quantum
when
of
you're
debt.
doing a dividend recap,
Yeah.
you're sitting around saying, well, what's the quantum of quantum?
Mm-hmm.
And then I'm like, quantum of what? Quantum Leap? You guys don't remember that show, Quantum Leap. That was a good one. Where a guy like jumped around through history and like fixed history, right? Like something was off in history, so he'd go back and fix it. Anyway, that's a whole other story. But the quantum, they never say quantum of debt.
Yeah.
Because you can't
Mm-hmm.
throw a preposition in there.
Right.
Prepositional phrase. So it's like, what's the quantum? I don't know, 100 mil, 200 mil. I mean, what is it going? I mean,
8 turns.
8 turns. Yeah. What if?
Turns, true.
Yeah. What if can quantum be like just $1 million? Feels like you need more than quantum. Seems like
$5.
a big,
It's a
heavy
daunting-
number.
Quantum.
Yeah.
Yeah.
It's like quantum is like that sounds like a
serious.
lot.
Yeah. It's
This is serious business if you're talking quantum.
yep.
So you better show up with a value creation plan. If you're gonna use that much quantum.
Right.
Here are my 2 faves that we'll end on here. And this has been fun.
This is awesome.
really fun.
Yeah.
Industrial logic. This showed up, I think, in the last 4 or 5 years. It's a very investment banker term. Sometimes a private equity guy will call you and to explain the industrial logic of them investing or combining one of our companies with their companies. So industrial logic is basically like, it makes sense. It's like, why don't we just say that? Hey, it would make sense to put these 2 companies together. It would make sense for this company to be the buyer. But no, it has to be industrial
From an
logic.
industrial perspective.
From an industrial logic
Yes.
perspective. If you're putting perspective at the end of a sentence, you know you've already used too many words.
perspective. Yeah.
From an industrial logic perspective. So industrial logic just means like, yeah, it makes sense. But you'll get pitched. Oh yeah, the industrial logic here makes a lot of sense. But we don't have a unique angle. I get the industrial logic, but we just don't have a unique angle.
Totally.
That's a great reason to turn a deal
Yeah.
down.
Yeah.
Again, catch-all. No unique angle. And then this one, we're even saying this a lot. So we're going to have like a swear jar for this one. It's all about the unlock.
Unlock.
The unlock.
Yeah.
You got to It's not even like specific to something. The unlock.
General.
If we did this, I think that's the unlock. The unlock of what?
The value creation plan.
Oh, yeah. Or multiple expansion.
Yeah.
It could unlock de-risking.
Unlock
it could also
the levers.
I mean, levers could unlock a lot of white space here, and could de-risk the deal. It could move the needle. It could move the needle quite a bit.
Yeah.
If we only had a unique angle.
Totally.
Yeah.
All right. Did we leave any off
We probably left a lot off, but
Yeah.
for another one?
Yeah.
We've got room for
We
another
could
one.
take this offline and circle back.
let's
here.
take this offline. Yeah.
Oh, we forgot to double click.
Yeah. Exactly.
Oh my gosh, we're already getting ahead of ourselves. All right. Well, hey, for your first voyage, the maiden voyage on the Funcast, one of the first video episodes we've done, that was amazing.
Yeah, it was a
And
lot of fun.
I
Yeah,
think
it's fun.
people are actually going to get something from this because you'll be sitting in meetings and all of these things will be said. And you'll know which ones to laugh at, which ones to write down to tell your friends, when to grab a paper bag, turn your camera off and hyperventilate.
Exactly.
Or when to kick your friend under the table and be like, I can't believe they just said that again. That was amazing. A friend of mine who I've known for 35 years kept a running list of these and still does in meetings. And he's like, someday I'm going to publish a book. I'm like, I think that someday is now. So we got ahead of him with the podcast. I love having you guys around. I love working with you too. This was super fun.
This
Now
was
everybody got
Yeah.
to see why. I love spending time with you two. Bye for now.
Neither this podcast nor any of the information contained here constitutes an offer to sell or a solicitation of an offer to buy any security or instrument in, or to participate in, any ParkerGale fund or other investment vehicle. Past performance is not indicative of future results, and there is no assurance that any ParkerGale fund will achieve its objectives or avoid significant losses. This podcast may contain forward-looking statements. Such statements are subject to various risks and uncertainties. ParkerGale is an investment advisor registered with the United States Securities and Exchange Commission. Registration with the SEC does not imply a certain level of skill or training. Guests appearing on the podcast may or may not be a financial sponsor of the podcast or an episode of the podcast. ParkerGale may have business relationships with certain guests, sponsors, or organizations mentioned during the program. In some cases, guests or sponsors may provide services to or receive services from ParkerGale, which creates potential conflicts of interest. Any sponsorship of this podcast does not imply endorsement by ParkerGale and is not provided in exchange for, nor intended to solicit, business between the sponsor and ParkerGale. The appearance of any guest does not constitute an endorsement or testimonial of ParkerGale or any fund. For additional information regarding ParkerGale, please refer to ParkerGale's website, www.parkergale.com, or Form ADV, available at advisorinfo.sec.gov.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink